Warren, we've had a great start to the year. Not only in South Africa, but worldwide investment markets had a great run. In effect, it's probably one of the best 3 to 4 month periods we've seen for a very long time. And that also has an impact on investment performance, not only for the since the beginning of the year, but if you go back 12 months. If you look at the South African market, South African local investors in, let's say, a balanced fund, what does the number show?
You're right, Theo. It's for once, been really nice to be able to talk to clients and our colleagues about rising markets and explain why things are going up and not just explaining why things are going down the whole time. And so if we look at a typical balanced fund in South Africa, over the last year, so for the last 12 months, it's given investors a return of about 5.5% for the 12-month period, which doesn't sound brilliant, but when you give it a context of what happened for the calendar year, so for the whole of 2018, investors actually lost a little bit of money. So to suddenly then, a few months later, make up that loss and actually start to get ahead, it shows you that things have gone much better than that 5.5% is reflecting. And we can see that in the numbers from the 1st of January to now, which is pretty much the end of April. And that's just below 9% for the year to date. And that's a cracking start to a year. And what's interesting about that is if we were sitting here on the 1st of January trying to forecast why the markets would do well in South Africa or why they would do badly, we would look at a couple of issues. One, we would have spoken about the election ad nauseum, which has been spoken about ad nauseum, but we wouldn't have expected anything to happen until the elections were over and that there was a good investor-friendly result for that. That hasn't happened yet. We would then have looked at the cabinet that was created by Ramaphosa, if he's going to be the man in charge, and said, is that an investor-friendly cabinet? That hasn't happened. We would have spoken about land expropriation being resolved and done in an investor-friendly way. That also hasn't happened. And then Eskom, that we would have spoken about, is it being fixed in a correct way? Is the restructure happening? That also hasn't happened yet. And yet here we are, a return of nearly 9% for a 4-month period, and no real reason why. We can't give you a predictable, forecastable reason as to why this was going to happen if we were sitting in January. And now that we look back, we can say, oh well, the emerging markets recovered along with American markets, but there wasn't a particular trigger that we could have predicted. So it shows you the massive folly of investors trying to predict markets, trying to make huge decisions about getting into cash now because cash was the best performing asset in 2018. So let's go there because 2019, that looks like it's not going to be the case. So far, so good. It's going to be shares. And so for an investor to make a prediction based on what happened in the last 12 months would have been crazy and would have actually cost them a heck of a lot of money.
Well, Warren, that is not a South African phenomenon. It's actually a worldwide phenomenon if it comes to retail investors and members of pension funds. Now, there is an academic study at Dalbar Study, usually what the study is referred to, but that gets updated every 6 months by JP Morgan Asset Management in the US. And what they're trying to establish, they look at the average retail investor, including individuals and including pension fund members. And they look at how these investors perform and then how they do relative to inflation, relative to the market, and relative to the funds that they are invested in. And the key is that they underperform. The normal stock standard retail investors handsomely underperform the funds. They handsomely underperform the indices. And the reason for that is they make the mistake of trying to time the upswings, but also the dips. And it comes back to your point. In January, early January, the average retail investor had enough reasons not to think the market's going to run, had enough reasons to stay in cash. And subsequently, the market gave you the almost 9%. That's a 9% that you would miss if you try to time the market. So what Dalbar Study shows and what JP Morgan produces every 6 months is to give proof to the analogy that an investor that makes decisions based on market timing or predictions actually lose a lot more money. In effect, the average investor, retail investor in the US, doesn't even beat inflation, whereas the average fund actually beats inflation. But the problem is not the fund, the problem is the behavior of the investor, and that needs to be seen in light of the last 12 months, specifically since the beginning of the year.
So I think the secret for investors, Theo, is they've got to look at their own investment strategy. They've got to look at the factors that will determine how much of their money should be in cash, in bonds, property and shares. And once they make that decision, they shouldn't chop and change based on what the stock markets are doing or what they're not doing, or what was the best performing asset class last year, because that's really the way that you replicate the Dalbar study in a terrible way for investors. And that Dalbar study is so powerful because it's telling us that investment markets don't actually work for investors if we carry on doing the same things we've been doing for the last decades and decades before that. What we need to do is focus on this asset allocation. So when we tell investors to stick to your asset allocation, don't chop and change, what we're trying to do is break this Dalbar cycle and actually create a proper outcome for investors where they definitely beat inflation, where they get at least the returns of what the average balanced funds are doing, and ideally they get better than that over the very long term. And the only way they can do that is to stop playing the horse race of chasing last year's best performer. So our advice always is stick to your strategy, don't panic when things are going badly, and don't get too excited when things are going really well. For now, we can enjoy these good times, but the good times will turn again, and don't worry about it. That's what markets do. They come and they go, but stick to your strategy and you will get the best outcome over time.